Something extraordinary just happened in the silver market, and most investors have not yet understood the implications. Today, a major Wall Street institution released a set of projections that completely shifts the conversation around silver's future price potential. For months, analysts and investors have been debating whether silver could realistically break into triple-digit territory during the next phase of the precious metals cycle. Now, one of the largest financial institutions in the world has officially stepped into that debate and put a number on the table that few people expected to see coming from mainstream banking research. Bank of America has updated its internal outlook for silver, and according to their metals research division, the metal could trade anywhere between approximately $135 and $309 per ounce before the end of 2026. Think about that for a moment, because the number itself is not what matters most. What matters is where this projection is coming from. This is not a speculative blog post, not an internet forum prediction, and not a small boutique analyst trying to generate attention. This is one of the most influential banks in the global financial system, putting the possibility of $300 silver into formal research models and explaining the mathematical reasoning behind it. The projection comes from Michael Widmer, who leads metals research at the institution. His analysis does not rely on vague optimism or narrative-driven hype. Instead, the model uses a framework that serious precious metals investors have followed for years, the historical relationship between gold and silver prices known as the gold-to-silver ratio. By analyzing where that ratio has moved during past monetary stress events, the research team created a scenario analysis that shows how silver could realistically reach levels many investors once considered impossible. Their moderate scenario uses a ratio similar to what was seen during the previous metals bull market peak around 2011, when the gold-to-silver relationship tightened toward roughly 32 ounces of silver for every ounce of gold. Using gold prices in the region of $5,000, that ratio would place silver close to $135 per ounce. But the more dramatic scenario comes from an even more extreme historical example. During the explosive precious metals move in 1980, the ratio compressed toward the 14 to 15 range. If a similar compression were to occur again while gold trades in the $5,000 area, the calculation pushes silver toward the $300 region. What is remarkable about this analysis is not simply the price target itself, but the fact that a mainstream bank is now acknowledging the same mathematical logic that independent precious metals analysts have been discussing for years. For a long time, the idea that silver could dramatically revalue relative to gold was dismissed as unrealistic or overly optimistic. Now a major institution is presenting that possibility as a legitimate outcome within the current macroeconomic cycle. And the timeline they are discussing is not decades away. The projection specifically references the potential for this move to occur before the end of 2026, which means the market would only have a relatively short window to transition from today's pricing environment into an entirely different valuation structure. Before going deeper into the technical signals behind this thesis, take a moment to think about the broader implications. A move of this magnitude would not simply be another commodity rally. It would represent a fundamental shift in how capital is allocated across global financial markets. Precious metals would no longer be treated as niche assets sitting quietly on the edge of portfolios. Instead, they would become central components of the monetary system discussion once again. That is why understanding the underlying drivers behind these projections is so important. Right now, two significant technical developments are unfolding in the background of global markets, and both of them point toward a structural shift in favor of monetary metals. The first involves the relationship between gold and the equity market. For more than a decade, the dominant investment narrative was simple. Stocks were the primary engine of wealth creation, while gold and silver remained secondary assets that lagged behind. The data supported that narrative for years because equities consistently outperformed precious metals after the peak of the previous cycle. But something changed recently, and the charts are now signaling a major break from that long-standing trend. When analysts compare gold to the S&P 500 on a long-term ratio chart, they measure how monetary metals perform relative to traditional financial assets. For roughly 10 years, that ratio was trapped beneath a downward-sloping resistance line that originated after gold's peak during the previous cycle. Every attempt to break higher failed, reinforcing the belief that stocks would continue dominating portfolio allocations. But that ceiling finally gave way when gold pushed decisively through the resistance level on monthly closing charts. Once that breakout occurred, the move accelerated quickly. Over the following months, gold surged dramatically while the S&P 500 moved mostly sideways. In relative terms, the precious metal began outperforming equities in a way that had not been seen for years. This type of breakout is important because it often signals a major rotation in global capital flows. When investors start shifting funds away from overowned financial assets toward underowned monetary assets, the move tends to build momentum over time. Early in the transition, the change may appear subtle, but as more capital begins recognizing the shift, the trend can evolve into a powerful long-term bull market. Similar patterns have appeared in previous cycles, before large advances in precious metals prices. For silver investors, however, an even more important signal is developing within the relationship between silver and gold themselves. Instead of focusing only on the ratio in simple numerical terms, many technical analysts examine silver as a percentage of gold's value. This approach highlights how silver moves relative to the monetary metal that typically leads the sector. Historically, silver oscillates between periods of extreme undervaluation and periods where it dramatically outperforms gold during late stages of bull markets. During the last major silver peak, the spread between the two metals reached roughly 3%. That means the price of silver briefly represented more than 3% of the gold price. After the mania ended, the spread collapsed as the market entered a long period of correction and consolidation. In the years that followed, the relationship fell below 1% during several extreme moments of weakness, signaling that silver had become historically cheap relative to gold. For a long time, that compression persisted, frustrating investors who believed silver would eventually reassert itself. But recent price action suggests the relationship is beginning to change again. The spread has broken above key resistance levels that had contained it for years, marking what technicians describe as the early phase of a new expansion cycle. When that breakout occurred, silver prices were still trading around the mid-50s. Within a relatively short period, the metal surged dramatically, briefly pushing far above previous ranges, before experiencing the kind of violent correction that often accompanies early stages of powerful trends. Despite that volatility, the important signal is that the spread itself continues forming higher highs on long-term charts. That pattern indicates silver's relative strength compared to gold is strengthening rather than weakening. Historically, when this type of breakout occurs, it often precedes the most explosive phase of silver bull markets. The early move grabs attention, but the real acceleration tends to arrive later once broader participation enters the market. This is why many analysts believe the current environment could represent the beginning rather than the conclusion of a major repricing cycle for silver. The structural signals appearing across multiple charts are consistent with the early stages of large capital rotations that historically lead to powerful advances in precious metals. And that brings us back to the projections coming from major institutions today. When technical signals align with macroeconomic pressures and supply constraints, markets can move far more dramatically than most investors initially expect. Understanding that possibility is the first step toward preparing for what may come next. Now, before assuming that silver simply moves in a straight line toward those projections, it's important to understand how markets behave when they transition from long periods of stability into phases of explosive repricing. The path is almost never smooth. Instead, it is defined by violent swings, sudden corrections, and moments of doubt that shake confidence even among experienced investors. Many people watching silver over the past several years have felt exactly that frustration. Each time momentum appears to build, a sharp pullback follows. Prices surge, then drop aggressively. For traders focused only on short-term charts, this behavior can feel confusing or even discouraging. But when viewed through the lens of structural market mechanics, those movements often signal something very different. They reveal a system under pressure. One of the defining characteristics of modern commodity markets is the enormous influence of derivatives. Futures contracts, options, and leveraged positions dominate daily trading activity. In such an environment, price discovery does not always occur smoothly. Instead, it becomes compressed by layers of leverage and institutional positioning. When the system reaches a point where underlying supply and demand forces begin pushing against those layers, the result is instability. Trading interruptions, margin adjustments, and sudden price shocks become more common. Over the past year, those exact patterns have appeared repeatedly across several commodity markets, including silver, gold, and even energy contracts like natural gas. These events are often misunderstood. Many observers assume they represent signs of manipulation designed to permanently suppress prices. Others interpret them as evidence that the market is fundamentally weak. In reality, they are often better understood as pressure releases within an over-leveraged structure. When price movements threaten the stability of that structure, exchanges respond by adjusting margins or pausing trading activity. Those actions temporarily slow momentum, but they do not eliminate the underlying forces driving the trend. Instead, they delay the process of price discovery, pushing it further into the future. History provides several examples of how this dynamic eventually resolves. Markets that remain artificially compressed for long periods rarely drift gradually toward equilibrium once the pressure finally breaks. Instead, they tend to move violently. Prices jump across levels that previously acted as resistance. Daily swings expand dramatically as traders attempt to reprice the asset under a new reality. The metals and energy markets experienced this type of behavior during the commodity supercycle of the early 2000s. Copper and lead, for instance, spent decades moving within relatively narrow ranges before suddenly accelerating upward once structural demand collided with constrained supply. Silver may now be entering a similar phase. To appreciate the scale of the potential shift, consider the historical trading range the metal has occupied. For nearly half a century, silver oscillated between roughly $4 and $50 per ounce. That means an entire generation of investors grew accustomed to thinking of silver within that narrow band. When an asset remains inside such a long-term range for decades, market psychology becomes anchored to those levels. Analysts begin assuming that any move above the upper boundary will eventually reverse. But once a market finally escapes that kind of multi-decade box, traditional expectations often become obsolete. The initial breakout may appear dramatic on its own, yet it can represent only the first step toward a much larger repricing process. In silver's case, the early move beyond the old range has already exceeded many classical chart projections. That behavior suggests the market is no longer operating under the gravitational pull of its historical limits. Instead, it appears to be searching for a completely new equilibrium price. Another factor reinforcing this possibility is the dramatic expansion of global money supply during the past several decades. Since the early 1980s, broad monetary aggregates have grown at an extraordinary pace. Central banks around the world have repeatedly expanded liquidity in response to financial crises, economic downturns, and geopolitical disruptions. Each cycle of expansion has gradually reduced the purchasing power of major currencies relative to hard assets. When historical commodity prices are adjusted for these changes in monetary supply, the old peaks reached during previous silver cycles no longer appear as extreme as they once did. In fact, many analysts argue that simply accounting for inflation alone would already place silver's fair value far above the levels seen during the last bull market. When the effects of monetary expansion are added to that calculation, the potential price range moves even higher. This is one reason why the projections now circulating among analysts extend into the hundreds of dollars rather than merely revisiting the $50 region. The underlying monetary environment today is fundamentally different from the environment that existed when silver last reached those levels. The ratio analysis used by major institutions reflects this reality. If gold trades within the several $1,000s range, as many forecasts suggest, even a moderate compression of the gold to silver ratio would imply dramatically higher silver prices. A ratio near 30-to-1 places silver comfortably above $100. A ratio closer to 15-to-1 produces values approaching $300 or more, depending on gold's final price. These calculations are not speculative guesses. They are simple mathematical outcomes derived from historical relationships that have appeared repeatedly across previous monetary cycles. Still, acknowledging the bullish scenario does not mean ignoring the potential risks that could interrupt or delay such a move. Markets are complex systems influenced by countless variables, and silver is no exception. Several factors could slow momentum or produce significant corrections along the way. One of the most immediate risks involves continued intervention through margin adjustments or regulatory actions within futures markets. When volatility rises sharply, exchanges sometimes increase margin requirements to reduce systemic risk. While this helps stabilize the trading environment, it also forces leveraged traders to liquidate positions quickly. The resulting selling pressure can trigger sharp price drops even when underlying fundamentals remain unchanged. Traders operating with high leverage are particularly vulnerable to this dynamic because they may be forced out of positions at precisely the moment long-term investors are becoming more confident. Another potential challenge comes from the broader macroeconomic environment. In severe financial downturns, liquidity often becomes the most valuable asset in the short term. During the early stages of a major credit contraction, investors sometimes sell nearly everything to raise cash, including precious metals. Silver experienced this type of liquidation during previous crises before eventually recovering and moving higher. Such events can create dramatic volatility that tests investor conviction. Currency movements represent another variable worth watching. Precious metals are typically priced in dollars on global markets. When the dollar strengthens significantly against other currencies, metals can appear more expensive for international buyers. That dynamic sometimes suppresses demand temporarily and leads to periods of consolidation or correction. Industrial demand also plays an important role in silver's price behavior. Unlike gold, which is primarily held as a monetary asset, silver has substantial industrial applications. It is used in electronics, renewable energy technologies, medical equipment, and numerous manufacturing processes. If global economic activity slows dramatically, demand from these sectors could weaken in the short term. Such a slowdown would not necessarily eliminate silver's long-term potential, but could influence price movements along the way. Finally, there is the simple reality that markets often pause after large advances. Even during powerful bull markets, assets rarely move upward without interruption. Periods of consolidation allow traders to digest gains, reposition portfolios, and establish new support levels before the next leg higher begins. Investors who expect constant upward movement often become discouraged during these pauses. Yet historically, they are normal parts of long-term trends. Understanding these potential headwinds is important because they remind investors that even the strongest macro thesis does not eliminate volatility. Large opportunities often come with equally large emotional tests. Those who navigate such environments successfully are usually the ones who enter with realistic expectations rather than assuming every move will happen immediately. At the same time, the combination of structural technical breakouts, monetary expansion, and tightening physical supply creates a powerful backdrop supporting the bullish argument. Analysts watching these developments closely believe the current cycle may only be in its early stages. If that assessment proves correct, the next phase of the silver market could unfold far more dramatically than most participants are prepared for. And that leads directly into the larger set of forces now aligning behind the precious metals complex. Because when examining the broader picture, it becomes clear that silver's potential rise is not happening in isolation. It is part of a much larger transformation taking place across the global financial system. To understand why many analysts believe silver's next phase could be so powerful, it is necessary to step back and examine the broader forces reshaping the global financial system. Markets never move in isolation. Every major price shift is the result of multiple pressures building simultaneously beneath the surface. In the case of precious metals, several of those pressures are now converging in ways that rarely occur at the same time. One of the most significant drivers is the steady increase in physical demand. Across global markets, there have been repeated reports of tightening supply conditions. Dealers in multiple regions have noted difficulty sourcing large quantities of physical metal, particularly during periods when prices surge and investor interest increases. Premiums above spot price have periodically widened on major trading platforms and in key financial centers, signaling that buyers are willing to pay more than the official market price to obtain immediate delivery. When those types of conditions appear consistently, they suggest that the underlying balance between supply and demand may be shifting. Unlike paper trading, physical demand cannot be created artificially through derivatives. When investors or institutions seek to acquire real metal, the supply must exist somewhere within the system. If inventories are limited or production growth struggles to keep pace with demand, price eventually becomes the mechanism that restores balance. Historically, this process can unfold slowly at first before accelerating rapidly once confidence in existing price levels begins to fade. Another major factor influencing the metals market is the behavior of central banks. Over the past several years, many countries have increased their gold purchases at a remarkable pace. Nations such as China, Russia, and several emerging economies have steadily expanded their reserves, often emphasizing the importance of holding tangible assets within their national balance sheets. While most central banks focus primarily on gold rather than silver, their actions still affect the broader precious metals ecosystem. Increased gold accumulation signals a strategic shift away from exclusive reliance on dollar-denominated financial instruments and toward assets that function as long-term stores of value. When institutions responsible for managing national reserves begin moving in that direction, private investors tend to notice. The message is subtle but powerful. Central banks do not typically buy precious metals for short-term speculation. Their decisions reflect long-term assessments of monetary stability and geopolitical risk. If those institutions are increasing exposure to hard assets, it suggests they are preparing for an environment where traditional currency systems may face greater volatility. Monetary policy itself also plays a crucial role. Over recent years, global central banks have repeatedly adopted accommodative policies designed to support economic activity and stabilize financial markets. Lower interest rates, expanded liquidity programs, and large-scale asset purchases have become common tools used to manage economic slowdowns. While these policies may help maintain stability in the short term, they also contribute to long-term currency debasement. When the supply of money grows faster than the supply of tangible assets, the purchasing power of that currency gradually declines. Precious metals have historically benefited from such environments. Gold and silver cannot be created through monetary policy decisions. Their supply increases only through mining production, which tends to grow slowly and requires significant investment. As a result, when currency supply expands rapidly, the relative scarcity of metals becomes more apparent. Investors seeking protection against monetary dilution often turn toward assets that have maintained purchasing power across long periods of history. Another influence shaping the outlook for silver involves geopolitical tensions. The modern world is characterized by complex relationships between major economic powers. Trade disputes, sanctions regimes, regional conflicts, and shifting alliances all contribute to uncertainty within global markets. During periods when geopolitical risk increases, investors frequently look for assets perceived as safe havens. Gold has traditionally served this role, but silver often participates in those flows as well, particularly when momentum begins building within the broader precious metals sector. At the same time, a generational shift is unfolding within the investment landscape. Large amounts of wealth are gradually transferring from older generations to younger investors who have grown up during a very different economic environment. Many of these individuals witnessed the financial crisis of 2008, experienced the extraordinary monetary stimulus that followed, and then observed the surge in inflation during the years that came afterward. These experiences have shaped attitudes toward traditional financial systems. Surveys consistently show declining trust in institutions that once dominated investment culture. As a result, alternative assets have gained increasing attention. Digital assets captured part of that interest over the past decade, but tangible assets like precious metals remain an important component of diversified strategies for many investors seeking protection against systemic risk. This shift in perspective adds another layer of demand that did not exist in the same form during previous cycles. When all these forces are considered together, the bullish argument for silver begins to look less like speculation and more like the natural outcome of multiple structural trends. Technical breakouts, monetary expansion, physical supply constraints, geopolitical uncertainty, and generational shifts in investment philosophy are all pointing in the same direction. None of these factors alone guarantees a particular price target, but their combined influence creates a backdrop where large price movements become increasingly plausible. Still, the path forward will likely remain volatile. Markets rarely move in straight lines, and silver in particular has a reputation for dramatic swings. Sharp rallies are often followed by sudden corrections as traders lock in profits or react to unexpected macro developments. Those fluctuations can create the impression that the broader trend is uncertain, even when long-term forces continue building beneath the surface. For investors who have been following the silver story for years, the latest projections from major financial institutions represent an important moment. For a long time, discussions about triple-digit silver were confined mostly to independent analysts and specialized communities of precious metals enthusiasts. Mainstream financial institutions tended to dismiss such projections or avoid them entirely. Now, one of the largest banks in the world has openly modeled a scenario where those levels become possible within the next stage of the cycle. That shift in tone matters because it signals a change in how large institutions are evaluating the metals market. When mainstream analysts begin acknowledging scenarios that were previously considered fringe, it often reflects a deeper transformation occurring behind the scenes. Markets move through phases where ideas that once seemed unrealistic gradually become accepted possibilities as evidence accumulates. For individuals entering the precious metals space today, it is important to understand that these markets operate on long cycles. Silver has experienced dramatic moves in the past, but those moves developed over years rather than days. The surge from single-digit prices to nearly $50 during the previous cycle unfolded gradually before reaching its explosive climax. Earlier in history, similar patterns appeared during the late stages of the 1970s bull market. Each cycle has its own characteristics, yet the underlying psychology often remains the same. At the beginning, only a small group of investors recognizes the opportunity. As the trend strengthens, more participants join, gradually pushing prices higher. Eventually, momentum attracts widespread attention and speculation accelerates. By the time the final stage arrives, the move appears obvious in hindsight, even though it seemed improbable at the beginning. That is why the central question facing investors today is not simply whether silver can reach a specific number. The more important question is how individuals choose to position themselves in relation to the possibility of such a move. Some will prefer to remain cautious, waiting for further confirmation before allocating capital. Others may already be accumulating exposure based on the belief that structural forces are aligning. Regardless of the approach, the key principle is understanding the risks and time horizons involved. Markets reward preparation and patience far more consistently than impulsive decisions driven by emotion. Anyone considering participation in the precious metals sector must evaluate their own strategy carefully, balancing potential opportunity against volatility and uncertainty. What can be said with confidence is that the conversation around silver has changed dramatically. When institutions managing trillions of dollars begin publishing research that includes $300 scenarios, the market narrative shifts. Investors around the world begin reassessing assumptions that previously limited their expectations. And that is where the situation stands today. A major Wall Street institution has placed an extraordinary price projection into the public discussion, supported by historical ratio analysis and macroeconomic trends. Technical signals across long-term charts suggest the precious metals complex may be entering a new phase. Physical demand, monetary policy, geopolitical tension, and generational investment shifts all add further momentum to the thesis. Whether the final outcome reaches $100, $200, or $300, the forces currently shaping the silver market are unlike anything seen in decades. For those watching closely, the message emerging from these developments is straightforward. The era of treating silver as a quiet side asset may be coming to an end. A structural repricing of monetary metals appears to be unfolding, and silver stands positioned at the center of that transformation.